was saying last time, because I want us to move forward now. So this is the assignment that was given to our colleagues. And so what we're going to go over again, we are going to ascertain what goes in the profit and loss, what goes in the balance sheet quickly, since we had already done this at some point. And then we'll do the necessary workings that need to be worked on. Then from there, we'll present the profit and loss statement and the balance sheet. Have you heard the outline? We are ascertaining what goes where and what and under what section. You get the point, right? And then from there, we will do some workings that need to be done. And once from there, then I'll present the profit and loss and the balance sheets. Any questions? Can you confirm you are able to hear me clearly and we can proceed from here?
Confirmed. We can hear you, sir.
Okay.
We can proceed.
Thank you. Thank you so much.
Sorry, it has started bumping your
So
network.
now, let's start with the first thing. Hello, can you hear me?
Yes, much better. It was bumping.
Oh, okay, that's fine. Let's start by ascertaining what goes in the profit. Let's start from the advertising. Advertising, where does advertising go to and what under what section? I want you to be that specific. Advertising. Let's do this one quickly now.
Profit and loss, and it's an expense.
Thank you very much. Advertising is a profit and loss and it's an expense. Bank.
Bank goes to the balance sheet, and it's a current. It goes under the current assets.
Current asset. Thank you. Bank loan. The bank loan. Where does it go to?
Balance sheet as well, and it's a liability.
Thank you very much. You see that, Kathy, you've been studying, right? You
I'm
are telling us
trying.
that.
Sir, also writing to my notes, Sky Mumakon, and going back and forth.
Oh, okay, I see. You have been studying. You have been following. You can remember that this is a balance sheet. Okay, that is a good one. Bank interests. Where do we put bank interest? What did you say?
This one,
I don't remember where it goes. Oh, okay. Go ahead, Brother Boniface.
Oh, thank you. Yes, you said it's an expense. It goes to
So
the
it goes in the
PL.
profit and loss. What about
Yes.
capital? Capital and capital introduced.
Goes in the balance sheet and is an expense. I stand to be corrected.
Okay, thank you very much for that one. Any other correction from there?
So yes, it goes to the balance sheet, and then it goes under capital and is it capital and liabilities?
Yes, under capital. All right. Carriage outwards and the computing expenses. Where do they go to? Anyone can turn on their mic, huh? I don't want to point finger people. Hey, you don't do that for this level of education, right?
Balance sheet.
It goes to the balance sheet and carriage outward. Carriage outwards. What about others? The carriage outward and computing expenses.
Sorry, sir. Are we on capital or are we on carriage outward?
Capital, carriage outward and computing expenses. These two, where do they go?
I think they go to the PL under expenses.
What section is that? Under expenses. right?
Sorry, sir, you're breaking.
What about payables and receivables? Payables, the payables and receivables. Hello?
The payables go to the balance sheet and it's an expense.
Okay, any correction to that?
Yeah, yes, it goes to the balance sheet as a current liability.
As a current liability. Maybe just a simple guide. When you talk about profit and loss, the common elements you find there are what? Incomes or the gains and the expenses, right? Expenses and incomes plus sales or revenue, isn't it? These are they that sit on the profit and loss. Then when you come to the balance sheet, you
Sorry,
have got
sir.
the
Come again. On profit and loss, you said income, gains, sales, and what?
income or gains, expenses, and sales.
Okay, thank you.
Right. Then on the balance sheet side, we have assets, liabilities, and the capital. You get the point, eh? These are they that come this other side. That's a guide. All right. What about receivables?
Receivables goes to the balance sheet under current asset.
Okay. Current asset, balance sheet. Discount received.
Profit and loss, and then other income.
Yes, this one is an income. What about drawings? Drawings.
Drawings fall under capital and they are subtracted from the capital.
So where do they go to? Pure or balance sheet?
The balance sheet.
You go to the balance sheet. Fixtures at cost. Where do they go to?
Balance sheet, and you had said something like they are non-current something asset. Okay.
Yes, they are non-current asset. Thank you very much. What about power?
Because we are paying it, so it's an expense.
This one
under
is an
profit and
expense.
loss. Mhm.
Allowance for receivables. What did you say about this one? Don't worry, we'll answer the question. Okay, so we say that the allowance for receivables basically is the chance or the probability that the debtors are going to default. You get, there is that provision that you give on all the accounts that are owed to you. So you assume that what if these persons don't settle their accounts? Okay, you have. Is that clear?
Sorry,
So
sir,
now,
your line is bad, is breaking in and out.
the line is cutting here. Is there any improvement now?
Yes.
Okay, thank you very much. So that's about the allowance for receivables. I said that this one, you could see that we use it in the profit and loss, and also we use it in the balance sheet under receivables, as you're going to see when you do some working. What about sales? Sales, where do they go to?
The profit and loss
the
account.
Profit and loss.
Yes.
What about purchases?
Also profit and
Sales
loss.
goes to,
What about rent and salaries?
There are also expenses, profit and loss.
Right. What about depreciation and opening inventory? Okay, so in opening, go ahead.
Opening inventory, you had said profit and loss.
Yeah.
And then you said it's an asset, I think.
Depreciation on assets. Where do you take it? So the accumulated depreciation goes to the balance sheet. The accumulated depreciation, because this is the level of loss that has occurred on the asset, the value that the asset has lost from the time you acquired it. Now, when you're done doing this, are there any questions before we go to the workings? There are a few workings that we need to do. Then you can be fine. Hello? Do we have any question before I go on to the workings?
So the depreciation, since it's on the balance sheet, is it an expense?
Where it is right now, it's not an expense. This one, it will go under capital. The one which will be an expense is the depreciation that we're going to calculate. Which one is this? This one. Because this is the, no, sir, explain as a profession. Okay, listen, are you able to hear me?
Yes.
Yes.
Now, from the time you acquired the fixtures up to the 1st January 2021, the fixtures had lost the value of what? Of 30. You're following, right? That's the total value they had lost from the time you acquired. Their total value, you bought them, that's the cost. You got them at, what is the cost of fixtures? The cost of fixtures is what? 120. You get it, right? Out of 120,000, they had lost the value of what? 30,000. You're following, right? As of 1st January 2021. Are you following?
Yeah. Yes.
Now,
Yes.
from 1 January up to 31st December 2021, they also lost some other value. You get it, right? There is some other depreciation, which is the depreciation in the year of concern, right? In the year of concern, the year that we are talking about, this is, 2021, from January up to December. You get it? That is the depreciation that you're going to calculate. Usually it is found, the information is found under additional information. Get the point? So now here, we are not calculating. They've already told us that the depreciation is provided at the end of 31st December 2021 as 30,000 on fixtures, which means now from January, you're following, right? Up to December 2021, of course, this asset lost what? 30,000. You're following it, huh? You're following?
Yes.
Then from the time we acquired it up to this January, all the way from whatever, it had lost already 30,000 as of 1st of January. You get the point? So when you go to the balance sheet, you consolidate this, you add them together. This is called the total depreciation. Now listen carefully. This depreciation that has occurred from January to 31st December in the year of concern is an expense. You get it, right? This one is an expense, but the total of this is not an expense. It will be put under liabilities to reduce the value of total assets there, or not under liabilities, under assets there, to reduce the value of assets there. The total, because there you will report the total depreciation. You will see that. So we'll add these two. Is that clear?
When you
Did
say
you get
add
it now?
these two, you mean the two 30,000s?
Yes. This one from
Okay.
the time we acquired it, and this new one that has occurred from January to December. So it will be 60,000. That will be the total depreciation you report in the balance sheet. Clear?
Okay.
Okay. Thank you very much. All right, now, let me comment now on inventory. This is the closing inventory. You know, the closing inventory is put under the profit and loss statement, right? there is a prepayment of 4,000 on rent. What do we do with the prepayments?
Prepayments are subtracted from the expense. Let's say this we're talking about rent, which was 12,000. So we subtract
it will be 12,000 minus 4,000, right? The prepayment, which will make it 8,000.
Yes.
Isn't it? Thank you. What else do you do with the prepayments? Okay, this value of prepayments will also go under current assets in the balance sheet. Is that clear? The same 4,000. Did you get that one?
You said it to go where?
Balance sheet as current assets. Remember, under current assets, you put prepayments, isn't it? Yeah.
Come again, sir?
And it will go under current assets as a prepayment in the balance sheet as well. You got it?
I'll
And as
just
for
write it
inventory,
down. It goes in the as current assets where?
in the balance sheet. The current assets are in the balance. Then the inventory, this closing inventory, it goes in the profit and loss and also in the balance sheet under current assets, isn't it? You put there is inventory there under current assets. Though this closing inventory is the one that you put there, as you're going to see. That is clear, right? All right, there is an accrue for power. Accrued expenses, what do you do with accrued expenses? These are expenses owing. You have already incurred them, but you have not yet paid. You've already used power, but you have not yet paid for power. 2,000. What do you do with them?
As you said, it's an expense, so it goes in profit and loss.
So how do you treat the accrued expenses?
It goes in the balance sheet.
As what?
Current liability.
Yes, the accrued expenses, they go under current liabilities in the balance sheet. What else do you do with them? They are added to the respective expenses. You get it, eh? The prepayments you deduct, but these are added to the respective expenses. So for power, the amount for power, you will add the 2,000. Is that clear? That applies the same to this 1,000 here for the crashed computer, where somebody repaired it, but they have not yet claimed the amount. Is that clear? Hello?
We're here.
Hello, sir. We're following.
Then the 30,000, I think I've already explained. This is an expense. It will go in the profit and loss. It's a depreciation on the fixtures, on the non-current asset. The one that I should make mention of is this allowance for receivables. Remember, we already have the allowance for receivables in the question as 4,000, isn't it? This is at the beginning of the period. The allowance, that provision, okay, that amount you keep that, oh, maybe they won't pay. It was just 4,000 when you opened the period, right? But now, at the closing of the period, it is 5% of receivables. Our receivables is 60,000. So you need to take 5% of that to get how much the allowance for receivable is at the closing of the period. So what is 5% of that? 5 over 100, that's 5% times 60. What do you get? This is the closing allowance for receivable at the end of the period. When you started, it was 4,000. When you're closing it, is how much? Hello?
Should give us 300.
300.
It can give us 3,000.
3,000. Sorry.
Yes, it has given us 3,000. So you have seen that from the opening of the period, the allowance for receivables has reduced, isn't it? it has reduced by 1,000, right? Have you seen that? It was 4,000, now it is 3,000, isn't it? So since it's a reduction, this 1,000, it will be added under other incomes just below the gross profit there. This 1,000 is an income to you if it's a reduction. But if this were an increase, if it were an increase, that would have been an expense to you. The increase in the allowance for receivables is an expense. So this 1,000 would have been put under expenses. Is that clear? So you just have to ascertain, did it increase or did it decrease? Did you get that one?
Okay.
So now that it increased, is an other income. Then this is 3,000, this closing allowance for receivable shall be deducted from receivables in the balance sheet. You will see that your balance sheet is, your receivables is 60,000. You shall deduct 3,000 from there. So you report 57,000 as the value of receivables in the balance sheet. Is that clear?
So we're still adding this 3,000, even if we took 5% out of it.
Which one is 5,000?
Sorry, not 5,000. Because you've said we should subtract 3,000 from 60.
Yes, in the balance sheet. Now, what I was explaining was in the profit and loss. Now, when you got the balance,
okay.
Yeah, that's a treatment. Are there any questions before I show you the profit and loss, how it should sit? So the profit and loss is
sorry,
sitting.
sir. Before the profit and loss. So all these, as we were identifying them, you know, for instance, advertising goes to profit and loss and expense. Is there an example, or is it the one you're showing me? Maybe I'm jumping the gun.
This is the same example.
Okay. I was just about to ask if there's something you can show us.
This is what I'm showing you now, how to write it. This is.
Thank you, sir.
This is actually, this is the fourth example I'm presenting on income statement. Yeah. So here it is again. This is how it should have it is supposed to sit. Sales in the profit and loss. In the last column, then you less cost of sales according to the format that I sent you. Then opening inventory. Opening inventory. Here you add the purchases, you know. Opening inventory plus purchases gives you this cost of goods, and you deduct from this the closing what? Closing inventory. So that you can have the cost of goods sold. And this cost of goods sold should be deducted from what? From sales, so that you can have the gross profit. Have you followed up there?
I think I'm okay up to here. I don't know about the others.
Okay. So deduct this from what? From sales, you have the gross profit. Now, to the gross profit, you add the other incomes. Discount received plus the reduction in the allowance for receivables that I told you, the 1,000. Here it is. It's an income. So that your total income can be what? 283,000. You're following, right? When you add the gross profit plus these other incomes, it will give you total income. Yeah? When you do that, you can now less expenses, isn't it? Deduct all the expenses. Advertising, bank interest, carriage outwards, plus computing expenses. I told you computing expenses had an accrue that you added, that one for 1,000. You get it, right? Power had an accrue. This is what you do. Rent had a prepayment. You deducted it. Salaries and depreciation on fixtures was 30,000. Add all these, they give you this figure that you should deduct from total income to get net what? Net profit. Is that clear?
Okay.
Kwasila, that's about...
Is there... I know you said you shared these. A longer version, I just want to take a screenshot. From
a longer version of the...
Remember, gross profit... I'm giving
you this. Now I'm giving you this immediate after class. You have it as your copy.
Oh, okay. Thank you, sir.
Let's go to the balance sheet. This is what I was saying. I said when you reach to the balance sheet, you start with non-current assets. According to the formats I gave you, you do costs of the fixtures minus total depreciation. This is the depreciation I was talking about. You deduct it. So the remaining value is 60,000. But since we only have one non-current asset, right? The fixtures. Or one non-current asset, yes. Then you are done. You go to current assets. Closing inventory. This is what I was telling you. Then receivables, I told you that you deduct what? The allowance, that closing allowance for receivable, the 3,000. You remember? This is it, 57,000. Prepayment, I told you that prepayment will be part of assets. And you add these are assets for you. Okay? I've moved very fast. Yeah. Okay, yeah, that is. So from these assets, current assets that you have, you can deduct the current liabilities. You've seen them. Payables, accrued expenses. You had those accrued expenses. The 2,000 for power and the 1,000. Deduct all these from the current assets. The 105 is total current assets. The figure that you remain with, this one, you should add it to that value that remains so that you remain with net assets of 122,000. Then you can say finance by you put capital plus capital added. Then you add the net profit, right? That you got from the profit and loss. Then you can deduct the drawings, and this is your total capital. You can add the long-term liabilities like the bank loan that you had, which was of 40,000. Then whatever you find, it should balance. It should balance with the current assets there, so that it's true what we're saying, that assets less liabilities should be equal to capital. So basically, that's what you are doing. Nothing much, nothing less.